Welcome to Essential Biz Marketing. This appendix explores the Plaza Accord, yen carry trade, short selling, business cycles, and the dollar's global role. Most textbooks describe exchange rates in abstract terms, but real-world currency movements reflect geopolitics, speculation, and strategic policy responses. In this appendix, we'll connect 5 key areas in one strategic map. Each concept builds on the last to reveal the deeper forces shaping global finance. In this appendix, we'll connect 5 key areas in one strategic map. Each concept builds on the last to reveal the deeper forces shaping global finance. The Plaza Accord marked a turning point in global exchange rate coordination. In 1985, major economies agreed to collectively devalue the US dollar to fix trade imbalances and reduce tensions. Japan and Germany faced pressure to revalue their currencies. The US aimed to ease its trade deficit while stabilizing global capital flows. The agreement caused sharp appreciation of the yen. This had far-reaching effects on Japan's export economy and laid the groundwork for new financial strategies. Japan's currency underwent a dramatic shift immediately after the Plaza Accord. Between 1985 and 1987, the yen appreciated by 50%, moving from 240 yen to 120 yen per US dollar. This marked one of the sharpest currency adjustments in modern financial history. The strong yen didn't just shift exchange rates, it changed how Japanese goods were priced abroad. By 1987, 1,000 yen had doubled in dollar value, from $4.17 in 1985 to $8.33 in 1987, making Japanese exports far more expensive in global markets. Currency appreciation hit the core of Japan's economic model: exports. As prices doubled for foreign buyers, Japanese firms lost their edge in global markets, weakening a system long reliant on trade surpluses. Japan slashed interest rates to revive its export competitiveness. To offset the yen's sharp rise, the Bank of Japan cut interest rates from 6.0% to 2.5% between 1985 and 1987. The goal was to restore trade strength, but the move also flooded the domestic economy with cheap credit. Easy money flowed into speculation, not exports. From 1986 to 1990, Japan's Nikkei index tripled, from 13,000 to over 39,000. Property values in Tokyo and Osaka soared, driven by loose credit and aggressive speculation fueled by prolonged low interest rates. The boom triggered its own demise. To rein in the overheating economy, the Bank of Japan raised the policy rate from 2.5% in 1987 to 6.0% by 1989. The shift from ultra-loose policy to tightening marked a turning point, setting the stage for asset price collapse and economic contraction. Tight money triggered a domino effect. As interest rates rose sharply, loan volumes declined, choking off credit to businesses and real estate developers. In response, property prices and stock values fell rapidly, causing a drop in investment and a sharp contraction in aggregate demand. Falling prices infected the banks. The collapse in asset values created a wave of non-performing loans, NPLs, as collateral lost its worth. Banks, now burdened with bad debts, cut lending further, accelerating the credit crunch and paralyzing economic recovery. The economy froze, not just financially, but psychologically. Corporations prioritized debt repayment over new investment, while banks, fearing further losses, avoided new lending altogether. This mutual retrenchment deepened the downturn, turning a cyclical correction into a structural stagnation. A lost decade became the new normal. The bursting of the bubble gave way to deflation, declining productivity, and chronically weak consumer demand. With banks unwilling to lend and firms reluctant to invest, Japan entered a prolonged slump that defined its economic narrative for decades. For the U.S., the Plaza Accord delivered results. Following the 1985 agreement, the U.S. dollar depreciated significantly, helping reduce America's trade deficits and restoring global competitiveness for American exporters. For Japan, It was a perfect storm. Japan suffered a triple blow: a surging yen, excessive monetary easing, and lax regulatory oversight. These factors converged to create fertile ground for one of history's most destructive asset bubbles. The aftermath outlived the boom itself. Japan's real estate and equity bubbles eventually burst, triggering a prolonged economic stagnation. What began as a coordinated currency realignment led to decades of structural malaise. Missteps magnify external shocks. Japan's experience shows how external currency shocks, when met with misguided domestic responses, can have devastating long-term consequences. The Plaza Accord's legacy is as much a cautionary tale as a policy milestone. The Plaza Accord had unintended side effects. After 1985, Japan slashed interest rates to offset the strong yen and protect exports. This made the yen the world's cheapest borrowing currency, laying the groundwork for the global yen carry trade. Cheap money flowed to where it paid more. Investors borrowed yen at minimal cost and reinvested in high-yield currencies like the Australian dollar, Brazilian real, and others. The profit came from exploiting interest rate differentials across countries. Currency moves can flip gains into losses. A sudden yen appreciation can wipe out profits as investors convert earnings back. Such trades also cause volatile capital flows, leading to market distortions and financial instability. One country's rates can reshape global finance. Japan's ultra-low rates fueled speculative flows into emerging markets. These flows amplified market volatility and introduced systemic risk into fragile economies worldwide. The yen became a lever for global speculation. The yen carry trade, driven by Japan's low-rate policy, reshaped capital flows globally. It intensified speculative behavior, highlighting how domestic monetary policy can affect international financial dynamics. Let's break down how yen carry trades operate, step by step. It starts with borrowing 10,000 yen from a Japanese bank at a low 0.5% interest rate when the exchange rate is 100 yen per $1. The trader then converts it into $100 to invest abroad. The next step is deploying capital into higher-yield markets. The trader uses the converted $100 to buy a one-year U.S. Treasury bond that offers a 5% interest rate. This step sets up the interest rate spread, which is the foundation of the carry trade strategy. The trade itself impacts currency markets. As more traders borrow yen and convert it into dollars, the supply of yen increases while the demand for dollars rises. This causes the yen to depreciate to 110 yen per $1, a shift that will later enhance returns when converting back to yen. A year later, the investment reaches maturity. The U.S. Treasury bond pays back $105, which includes the original $100 principal and $5 interest. Meanwhile, the yen has weakened to 110 yen per $1, setting the stage for conversion in the next step. The final return is brought back home. After receiving $105 from the U.S. Treasury bond, the trader converts it back into yen at 110 yen per $1. This results in a total of 11,550 yen, ready to repay the original loan and calculate net profit in the next step. Now the math comes full circle. The trader repays the original 10,000 yen loan plus 50 yen interest, 0.5%, totaling 10,050 yen. Subtracting this from the converted 11,550 yen yields a net profit of 1,500 yen from the carry trade. Let's now turn to what happens when the cycle reverses. The investor borrows 10,000 yen, converts it into $100, and invests in a one-year U.S. Treasury bond at 5%. Just like before, this weakens the yen from 100 yen per $1 to 110 yen per $1 as capital flows outward. But the Bank of Japan has yet to move. This is the final calm before interest rates rise. The reversal officially begins with Japan's first move. The Bank of Japan raises interest rates from 0.5% to 2%. This marks a pivotal shift away from ultra-low borrowing costs and sets the stage for a reversal of global capital flows. Markets price in more hikes. yen demand surges. Investors expect Japan to continue raising interest rates, making Japanese bonds more attractive. Investor flows reshape the currency landscape. As expectations shift, investors begin selling dollars and buying yen. The result, yen supply tightens while demand surges, driving the exchange rate from 110 yen to 90 yen per dollar. Let's see how the numbers change when the yen strengthens. The investor receives $105 from the matured U.S. bond. But with the yen now at 90 yen per dollar, converting this yields only 9,450 yen, a sharp drop from the expected return when the yen was weaker. Now the carry trade comes full circle, ending in loss. The investor must repay the original 10,000 yen loan plus 200 yen interest at the new 2% rate, totaling 10,200 yen. But the conversion from $105 yielded just 9,450 yen, resulting in a net loss of 750 yen. The yen's appreciation has completely reversed the trade's profitability. Losses don't stay isolated, they ripple through markets. As carry traders face yen conversion losses, they begin liquidating dollar assets to cut exposure. This sparks a wave of dollar sell-offs, accelerating declines in U.S. bond and equity markets. What began as an interest rate shift in Japan triggers global financial volatility through speculative unwinding. Now let's examine a real-world example of currency collapse. In 1992, hedge fund managers, including George Soros, identified weaknesses in the British pound. They believed the UK couldn't sustain its fixed exchange rate under the European Exchange Rate Mechanism, ERM, due to economic imbalances and low reserves. Hedge funds made their move with bold precision. They borrowed pounds, sold them for stronger currencies like the German mark, and planned to buy them back after devaluation. This short-selling strategy relied on the assumption that the British government would eventually be forced to abandon its defense of the pound. The Bank of England fought back, but it wasn't enough. To defend the pound, the UK raised interest rates 3 times in one day, from 10% to 12%, then 15%, to attract capital and support the currency. Despite these extreme hikes, the market pressure was too great. The pound collapsed, and the UK withdrew from the ERM, confirming the speculators' bet. Let's look at the fundamentals before the fall. In 1990, the British pound was fixed at 2.95 Deutsche Marks per £1. Yet, GDP growth stood at 0%, unemployment hit 10%, and interest rates were 0% already high at 10%. Despite this, markets anticipated further rate cuts, reflecting low confidence in UK monetary policy. Weak confidence turns into real movement. With markets expecting rate cuts and doubting UK policy credibility, foreign investors begin withdrawing capital from the UK. This capital flight marks the first wave of pressure against the pound's fixed exchange rate. In a crisis, credibility beats inflation. Despite 5.4% inflation, Germany earned strong market confidence. Investors trusted its large economy, strong industrial base, and highly independent central bank, making it a preferred destination for capital fleeing the UK. The imbalance didn't go unnoticed. In response to these economic conditions, hedge funds led by George Soros saw a profit opportunity. They began preparing to bet against the British pound, expecting the system to break under pressure. Imagine you're Soros. What would you expect next? You see weak UK fundamentals and a strong Germany, so you bet the pound can't hold. You expect devaluation, from $1.42 to $1.20 per pound, and prepare to strike. To act, I need ammunition. As Soros, I borrow £7 billion, not to invest, but to challenge the system. This money will be my lever to force a shift. Let's show them we're serious. I convert the £7 billion into $10 billion at $1.42 per pound. A bold move. The more I sell, the more pressure builds. The pound is now under siege. The fall has begun. Time to move. Once the pound drops to $1.20 per pound, I strike again. With $8.4 billion, I buy back the £7 billion I originally borrowed. Timing is everything. This is how you turn imbalance into profit. I sold high at $10 billion, bought low at $8.4 billion. The result? $1.6 billion in profit. No factories, no goods, just strategy. This is short selling at its peak. The attack begins in full force. As speculation surged, investors massively sold off British pounds, flooding the market and driving the pound downward. The currency was now under overwhelming pressure. The UK fought back, but it wasn't enough. The Bank of England intervened, buying up pounds and raising interest rates from 10% to 12%, then announcing 15%. But markets weren't convinced. Investors believed the UK lacked the reserves to defend the fixed rate, and the selling continued. Then came the breaking point. On September 16, 1992, the UK exited the European Exchange Rate Mechanism, ERM, and let the pound float. The result? A 15% plunge from $1.42 to $1.19 per pound and £3 billion in government losses. While the government lost, others gained. George Soros's quantum fund emerged as the biggest winner. Soros personally earned $1 billion, securing his nickname, the man who broke the Bank of England. Let's start with the structure of every economy. The business cycle moves through four main phases. Expansion, where growth accelerates. Peak, the high point of output. Contraction, recession, marked by slowdown and decline. And trough, the bottom before recovery. This loop repeats across economies and eras. Policy isn't reactive, it's strategic. Each phase of the business cycle responds to two main forces: monetary policy, managed by central banks, and fiscal policy, driven by governments. Both must be aligned with cycle phases to maintain stability. One-size-fits-all doesn't work in economics. Each phase of the cycle has distinct characteristics, from growth to contraction. That's why policy responses must be tailored to each phase to avoid overheating or prolonged stagnation. Misalignment can worsen volatility and delay recovery. This isn't just theory, it's survival. Understanding the business cycle is essential for making smarter economic decisions. It helps policymakers plan ahead, investors adjust their risk levels, and business leaders time their strategies effectively. When you master the rhythm of the cycle, you gain the power to act early, before surprises turn into setbacks. Let's start with the upswing of the cycle, the expansion phase. During this period, GDP rises, unemployment falls, and both consumer and business confidence strengthen. But growth comes with a price. Inflation may begin to build as spending and investment surge. This is a time of opportunity, but also one that demands policy foresight. Growth is welcome, but left unchecked, it can overheat. As GDP grows and confidence surges, central banks gradually raise interest rates. This makes borrowing more expensive, cooling excess demand, and keeping inflation in check. Monetary tightening at this stage isn't about stopping growth, it's about making it sustainable. Growth feels great, but discipline is key. As GDP rises and unemployment falls, governments reduce public spending and raise taxes. These fiscal measures limit excessive demand, prevent budget deficits, and reinforce monetary tightening. Fiscal restraint during booms creates space to act when the cycle turns. The boom can't last forever. We're entering the peak phase. Growth has been strong, but early signs of overheating are emerging. This marks the transition from expansion to the cycle's turning point. Here's what the economy looks like at the very top. GDP growth reaches its limit, but inflation surges and labor shortages emerge. Firms struggle to hire, wages rise rapidly, and speculative bubbles appear in financial markets. It's an unsustainable high, setting the stage for correction. So how do central banks respond when the economy overheats? They tighten monetary policy, selling government bonds and pulling cash out of the system. They also raise interest rates to reduce borrowing and cool speculative activity. It's a calculated slowdown, designed to avoid a crash. At the peak, fiscal discipline becomes the front line. As the economy overheats, governments step in, cutting public spending and raising taxes. These moves slow down demand and ease inflationary pressure, supporting central banks in their fight to stabilize the cycle. Every boom eventually hits its limit. Now, the cycle turns. As inflation bites and demand cools, the economy begins to contract. We are now entering the contraction phase, where growth slows, risks rise, and uncertainty deepens. Now the economy enters its most vulnerable stage, the contraction phase. GDP begins to shrink, business investment falls, and consumer spending declines sharply. As demand weakens, unemployment rises, and confidence deteriorates. This is the recessionary cycle, marked by slowdown, layoffs, and economic uncertainty. When the economy contracts, central banks step in to soften the blow. They cut interest rates to make borrowing cheaper and launch quantitative easing to inject cash into the system. By buying government bonds and expanding the money supply, the goal is simple: boost lending and revive spending before the downturn deepens. During recessions, government action takes the lead. To counter falling GDP and rising unemployment, governments increase public spending, especially on infrastructure projects, and cut taxes to stimulate demand. These fiscal tools are designed to boost consumption, support businesses, and lay the foundation for recovery. After the downturn comes the bottom. The economy has contracted, but now it begins to stabilize. We are entering the trough phase, where output is at its lowest and recovery quietly begins to take root. This is the lowest point of the cycle, the trough. At this stage, GDP hits its minimum, unemployment peaks, and business investment remains depressed. Deflation may occur as demand collapses, and uncertainty keeps firms from spending. Recovery hasn't started yet, but the worst is behind us. At the bottom, monetary policy holds the line. With GDP at its lowest, unemployment peaking, and investment stalled, central banks keep interest rates low and continue quantitative easing. Their goal is to inject liquidity, maintain stability, and lay the groundwork for eventual recovery. In the trough, fiscal policy becomes the engine of recovery. Governments respond with expanded public spending and stimulus packages, targeting infrastructure, welfare, and direct aid. The goal is clear: revive demand, restore confidence, and set the stage for economic rebound. After the bottom, recovery begins. As stimulus takes effect and confidence returns, the economy enters the expansion phase. GDP starts rising, unemployment falls, and consumer activity picks up, marking a new cycle of growth. Let's zoom out and look at the full cycle. This entire process shows how monetary and fiscal policies shape the business cycle. When these tools are well aligned, they help prevent overheating or deep recessions. But if misaligned or disrupted by external shocks, instability can take hold. Let's begin our final section: the US dollar as the ultimate global export. Since the Bretton Woods Agreement in 1944, the US dollar has served as the cornerstone of global finance, trade, and monetary policy. It anchors international economic activity as the world's primary reserve currency. Beyond its role in reserves, the dollar dominates global transactions. Even after the gold standard ended, vital commodities like oil and gold remained priced in dollars, reinforcing its central role in global trade and finance. The global system circulates dollars through trade and capital flows, which are then recycled into U.S. debt. This loop generates structural advantages for the U.S., including seigniorage and financial flexibility that amplify its global leverage. Understanding this cycle is essential. The dollar's dominance isn't just financial, it's strategic. It grants the U.S. influence in global affairs and remains central to analyzing the power dynamics of international business and finance. The dollar's dominance didn't happen by accident. It began in 1944 when the Bretton Woods system designated the U.S. dollar as the world's reserve currency. Even after the gold standard ended, oil, gold, and other key commodities remained priced in dollars. ensuring global demand and locking in its central role. Global players don't just hold dollars, they chase them. Central banks and corporations around the world need U.S. dollars to trade, invest, and settle debts. They secure dollars by exporting goods, attracting foreign investment, or borrowing from international markets. This demand sustains the dollar's central position. Once countries secure dollars, the cycle continues. Right back to the U.S. central banks and global firms invest those dollars in U.S. treasuries to earn interest and protect reserves. The reason? Trust in U.S. repayment and the global status of treasuries as safe, stable assets, even at low yields. This recycling reinforces the dollar's dominance. The dollar isn't just a currency, it's a financial asset the U.S. can print. It costs just 20 cents to print a $100 bill, yet that bill is valued and used globally at face value. This seigniorage effect gives the U.S. a unique fiscal edge. The Federal Reserve returns surplus profits to the Treasury, indirectly supporting government spending. This newly printed money is transferred from the Federal Reserve to the U.S. Treasury. The government then injects these funds into the economy through spending programs. These government funds support U.S. companies, which in turn engage in global trade. American firms use dollars to import raw materials and goods from abroad. Let's bring it all together. The global demand for dollars allows the U.S. to run deficits without destabilizing its economy. As the world's reserve currency issuer, the U.S. enjoys monetary flexibility, seigniorage benefits, and structural leverage in global trade. This is the real power behind the dollar. Let's reflect on what we've covered. The Plaza Accord showed how coordinated policy can reshape exchange rates. Yen carry trades revealed the cross-border effects of low interest rates, and short selling reminded us that speculation thrives on confidence and asymmetry. The business cycle teaches us that no condition lasts forever. Economies rise and fall in rhythm. And the U.S. dollar remains a powerful geopolitical tool, shaping global finance far beyond borders. Thank you for watching. This concludes today's session. We look forward to exploring more topics together.